Coming up in today's episode, the media claims the S&P 500 has started a new bull market. The media generated AI hype has lured in a lot of retail investors. We've got a short squeeze in Carvana, up over 50% today. GM and Tesla announced a new partnership, sending Tesla stock up to $243 a share. Jobless claims jump to a 2-year high, and the volatility crush continues. What's up, guys? Welcome back to Click Capital. My name's Jared, and I'm going to take you through all the most important news, data, and charts from the markets today. And we've got a bit of a reversal of what we saw yesterday with mega cap tech showing up today and a bit of a pullback in the hardware economy. We did get those initial jobless claims coming in higher than expected at 261,000 versus 235,000. So we had been seeing the jobs market holding up, but we last got an uptick in the unemployment rate to 3.7%. So if those weekly initial jobless claims keep climbing, it's very well that the next unemployment rate, which we get on the first Friday of every month, could climb above 3.7%, which was the last reading we got. And if you look at this chart here, the blue line shows the monthly unemployment rate. You can see it blowing out there in COVID. And the yellow line I've got on this chart is a 20-bar moving average. So that's the average unemployment rate over the last 20 months. And you can see right now we're sitting right at the average at 3.7%. And in the gray shading here, that's US recessions. And I'll also just add on to the chart the S&P 500 here in the orange line. And what I've found with this pattern here is when the unemployment rate goes from a really low level and curls up above the moving average, most of the time we're about to go into a recession. And as I'll show you soon here, the S&P 500 always bottoms out after the start of recession. We saw that here briefly in the quick one back in COVID. And then also in the last recession in the GFC, you can see the unemployment rate in mid-2007 went above the 20-bar moving average. We went into recession at the start of 2008, and the S&P 500 bottomed out in March 2009 deep into the recession. Same story after the tech bubble in late 2000. The unemployment rate came from a really low level, curled up above the moving average. We went into recession, and the S&P 500 bottomed out in March 2003. And we see the same pattern when we go back in history. Unemployment rate comes from really low, goes above the moving average. S&P bottoms out during the recession. Same pattern again in the early 80s. Back in the 70s, we had the S&P dive really hard into late 74, again in the early 70s, and the same pattern all through back history. Even in the late 40s here, we went into recession. You can see the S&P bottomed out well into the recession. So here we are today with the unemployment rate at 3.7%, and that ticked up from the last reading, which was 3.4%. And that's just about as low as it's ever got. So you could kind of think of it as the labor market peaking out here. And we just saw that uptick in jobless claims, which I think is a bit more significant than the market's given credit for. And if we keep seeing those jobless claims tick up, then the next unemployment report we get in the start of July, if we see that at 3.8% or 3.9%, then we're pretty much on the cusp of going into recession. And of course, you look at the S&P 500, it's still quite elevated up here, and the valuations versus the bond market are elevated, and now we're seeing elevated optimism in retail sentiment and buying, and that's nothing against retail investors, as I'm one myself and you probably are as well. However, as a whole, retail sentiment is a pretty good contrarian indicator, as unfortunately most retail investors just follow what the media is telling them. And of course, the media just reacts to price and what is happening now. And we can see that across the media spectrum today. Go on the front page of the journal, the S&P 500 starts a new bull market. And that's because the general accepted definition of a bull market is when we rise 20% off the lows. And so when media everywhere has got these headlines like this, the S&P 500 is in a bull market, and then a lot of people go and check their charts and they see it going up. Everyone online's talking about it. People are making money. It's just very tempting for a lot of people to open new positions, especially in the hyped up stocks like NVDA. And here's Barron's as well. S&P 500 hits bull market territory. And this run we've seen this year is all the hype surrounding AI. And we've got Vanda Research saying that retail investors have helped drive a daily average flow of 1.36 billion into the stock market over the past week. And I'd say a lot of that money, it's found its way into NVIDIA, Apple, Microsoft, and all the other usual suspects. And we can see that show up in the data as well of the American Association of Individual Investors, which conducts a weekly survey on investors' view of the financial market for the next 6 months. So we call this the AAPL Investor Sentiment Survey, and it's currently pretty elevated here, as we just got the latest reading today, and we're coming in at 44.55. And the last time we saw that high reading was back in late 2021, just before the market topped out and we went into the bear market. So while this doesn't mean that the market's going going to peak straight away. It's like the fear and greed index. It can be a good contrarian indicator and indicate that we are getting a bit overheated up here. And of course, Wall Street and the media is adding fuel to the fire. Even Goldman Sachs came out and is bullish on 5 global stocks in a corner of AI, giving one 140% upside. How lovely of Goldman Sachs to give us a stock that's going to go up 140%. That's really nice of them. Now, if you listen to the billionaire hedge fund managers, they're a bit more independent and actually put their money where their mouth is and have a track record of managing money. They can see the edge of the cliff approaching. And we've got another one today. Billionaire investor Stanley Druckenmiller warns there's more shoes to drop and say Silicon Valley Bank was probably the tip of the iceberg. And he's saying he sees a recession coming because of the aggressive interest rate hikes from the Fed, which they still haven't successfully got inflation down to 2%. And again, if you look through history, when the Fed aggressively raises rates, they almost always break something and put the economy into recession, and that's kind of the only way to really get a hold of inflation. But of course, it's just too politically incorrect for Jay Powell to come out and say he's trying to cause a couple of million in job losses so we can get inflation down. But by aggressively hiking rates, that is effectively what he is doing. We've also got big structural problems with the US balance sheet as a whole, and one of the brightest minds in finance, Ray Dalio, confirms that by saying the US is at the start of a late big cycle debt crisis, and he's warned that there's a shortage of buyers at a time when the US is selling so much debt. In other news today, we've got a huge short squeeze, and Carvana stock actually got up to over 60% at one point today. And that's because they surprised their market at an investor conference and came out. And so they're expecting to achieve adjusted EBITDA of $50 million in the second quarter. I think the street was actually expecting them to continue losing money with their problems. And here's a quick look at Carvana. On the chart, you can see we ripped up on huge volume here today, 174 million shares. Actually got up to 26 a share. Came off a bit around the close, just trading at 24.65 after hours as I speak. And one of the big reasons for this rip is we do have a relatively small float at 84 million shares. And just taking you out to a weekly chart, you can see this being super compressed. I'll just change that to a log. We've been super compressed, sold off super hard. The stock had been heavily shorted by a lot of hedge funds, and with that surprised increased guidance, the market and all those predatory algorithms absolutely cornered the short sellers and made them pay today, because there was 57% of the float short, which is a huge percentage. So that's why we saw that big squeeze up today. And just to give you a look at the corporate insider activity in Carvana stock, so we're currently trading at 25 a share. Corporate insiders haven't traded in the stock in over 6 months. Their last trade was back in 21 of November, but it was a purchase. And just look at all those purchases into that weakness. They were buying starting in the 30s, down into the 20s, even at 7, 8, 11, 10, and 7 a share again. Large amounts as well, millions. Here's one for 42 million. And just to show you how well insiders are at trading their own stock, let's just scroll down. They were last selling it in the millions at $300 a share, $293 a share. They sold 2.9 million. And let me just scroll down for you and look at all these huge sales at the high 200s, 342, 357, 14 million, 21 million. Insiders offloaded hundreds of millions of dollars worth of stock as the market was ripping up in mid-late 2021. And like always, they just do a great job at coming onto CNBC and other media outlets and hyping up the stock, overselling the story. It's a new paradigm, it's different this time, etc., etc. Meanwhile, they're offloading hundreds of millions of dollars worth of stock to, unfortunately, mostly retail that is buying the story. However, as retail investors, we can take advantage of that by following the insiders. If me personally, when I see a stock that's ripped up, a huge percentage in a short time, and then insiders are offloading huge amounts, that tells me to beware, stay away from the stock. And on the other hand, we can see when they're actually loading up on the stock, that we can take that as a positive signal as well, as nobody knows the stock better than corporate insiders, and they're pretty financially savvy people as well, making smart decisions. In other news today, we're seeing continued strength in Tesla stock as they announce an extended partnership with GM to access the Tesla's supercharger network. And that makes the Tesla supercharger network open to GM drivers starting in 2024. And this comes after news we got a few days ago from GM CEO Mary Barra that admitted Tesla has the lead in EV cars, which is obvious to most of us. And she said that she doesn't see GM bound to sell a profitable EV to maybe 2030. That, and combined with some more positive news out of China that Tesla sold more than 77,000 vehicles in May, and new energy car sales in the country jumped 61%, has helped the stock. And Tesla's presence in China is one of the big reasons we've seen the huge run up in Tesla shares over the last couple of years. It's obviously a huge market, and Tesla has a pretty good position in it. And just looking at the chart of Tesla here, we closed up 4.5% today, but we're ripping another 4.5% after hours as I speak to 244 a share. You've been hearing me say I think it's a bit technically extended here. Looks like we were going to put in a bit of an island reversal yesterday, but we've ripped through that here today. And if you've been watching my channel, you know I'm a long-term permanent holder in Tesla, so I'm not complaining about the move. However, I'm not trimming or adding my position here. And if I just take you out to a weekly chart, we can see we are a little bit above this trend zone and coming into this bit of a resistance zone as well. And if I do a Fibonacci on that last down wave, we can see we're right just above the 61% retracement, and in between the 61 and 65% retracement, kind of where this resistance zone is what we call a golden pocket. So maybe we're a bit stretched here in the short term, but I still say this is probably a bottom. We might never see low 100s again in Tesla ever. And just going back down to the daily chart, Tesla had been a bit oversold relative to the rest of the market. We had, NVDA, Microsoft, Apple coming up to all-time highs, and it looks like Tesla's just catching back up, getting back to its year-to-date highs, and looks to be in quite a bullish run now with a lot of momentum. So at 244 a share, we're more than 60 points above the 50-day VWAP. So very extended here in short term. You could expect a pullback in the next week or two. However, in the medium term, this price action could be good for Tesla, and we very well could come back up into the high 200s, 300 maybe later this year after we have a short-term pullback if the market continues to hold up as well. And don't forget, we should be seeing the Cybertruck released at some point later this year, and that could induce a bunch of hype into the stock. And I shared with you in my daily videos in late May, I added to my long-term position at $200 a share. And I've committed to holding a core position in Tesla for the rest of my life. That I'll just trade around by attempting to buy the dips and sell the rips. And I know it's a controversial stock with a controversial CEO, but I am a long-term believer in the brand and their future potential in the clean energy sector as a whole. Just taking you through the rest of today's data, the market's assigning a 27% chance that the Fed will hike at the next meeting. Obviously that came off a bit today with that surprise increase in the initial jobless claims, but the market's still assigning a better than not chance we will going to hike in July. Fear and greed levels continue to climb here at 76. Reasonably busy day in the options market, just under 40 million contracts traded, 57% of them calls. Same story with people piling into mega cap tech. Dark pool traders pulling a little bit here, still slightly above neutral territory. And we've got quite a growing gap between corporate sales and corporate insider purchases, outpacing them almost 4-1 yesterday. And just a quick look at max pain on the SPY and Qs. So we currently got the SPYs at 429. We got max pain for this month's regular expiry OPEX at 410. So monthly options expire on the third Friday of every month. Then you've got weekly options and a select number of names, the real liquid stuff. And then daily options in the SP 500 and a few others as well. And so max pain theory is the price where the index would expire that would make option dealers, the option sellers, the most amount of money. So it's the point where the most amount of options would expire worthless. And the theory is that acts as a bit of a magnet for price. And so that's a little bit lower here at 410 on the SPY. Just quickly showing you on the chart, 410 would be around this level here. And same story on the Qs. We're currently trading at 353, but we got max pain for this month's OPEX quite lower at 320 there. So I thought I'd just point out that gap to you. And here's a quick look at the Qs on the chart today. So 320 is a bit lower down there. You can see today we did an inside bar on a bit lower volume. And so for this reversal candle here to kind of confirm, we really need to close below its low, and a close above its high could disprove it as well. So this could be the start of the reversal, but we still need a bit more of a confirmation on the downside for it. And just getting back into the charts now, here's the Russell having a little bit of a soft pullback. You heard me say yesterday we come up to the resistance zone, so I expected it to have a little bit pullback. We did get a little bit ahead of ourselves here with yesterday's candle completely above the buy sell band and the wave flow indicator. And if you compare that to the S&P 500 and the Qs, they're not quite as elevated right here. However, that could still be good price action in the medium term for the Russell, as we had been beaten down against the large caps. We squeezed up here and we looked to have broken out on volume, so it's normal to expect a bit of a pullback. We may pull back again tomorrow and into next week. However, we may have seen just a little bit of a short-term bottom on the Russell. International stock indices all coiling up and consolidating here. There's the DAX, the Nikkei having a little pullback, and the Aussie and China trying to find support here. The volatility crush continues, and that's a trend we've been seeing for quite some time now, is to absolutely dive on Friday or going into the Friday when a lot of weekly options expire. So we've got a lot of people loading up on calls, and unless those calls go well into the money, or the IV, especially on the short-term weekly options that people pay for these options, just get absolutely crushed, and that's what they have been this week. So this week would have been good if you've been an option seller. However, volatility pricing itself is moving around a bit more, and we can see that on the VVIX index, closing up a bit here today today at 87 and not finding new lows. And the price of out of the money put options on the SP500 continues to grow as well. Got the skew at 155. So a strange dynamic where at the money options are really cheap, as we can see on the VIX, but out of the money options are really high. So the market's really skewed towards tail risk here. Breadth just pulling back a little bit here today, 72% stocks above the 20-day average. Growth versus defensive sectors still stalling out at the top of the range. International developed stocks still really oversold here versus their American counterparts. Could be setting up for a bit of a mean reversion play here. Government bond yields continue to hold steady. TLT continues to defend their 101 support level. Dollar pulled back a little bit here today after we rejected off those 104.50 level. Bitcoin still consolidating. Commodities continue to hold up. Uranium finds new multi-month highs again. Consumer discretionary stocks continue to trade strong, along with the bounce in the retail stocks. Semiconductors still consolidating at this elevated level. Another strong move up in the aerospace and defense stocks. And just taking you out to a monthly chart on this ETF ITA aerospace and defense. And we're very close to all-time highs, which is one of the very few sectors approaching all-time highs. We've only really got semis and a few other tech stuff coming near all-time highs. Most other sectors are still well off their all-time highs. And that's because the US government continues to increase the defense budget. So a lot of government taxpayer money is going to find its way into these companies going forward. And a little bit of stability, price action in the defensive sectors, healthcare, staples, and utilities coming back up to tag their 50. Got the biggest bank in the world, JP Morgan, consolidating, and a bit of a triangle formation here. We can see that on the weekly chart. Prices compressing up and could be looking to break out further here. Inside day on NVDA closed at $3.85 a share. Apple finished a little bit up today but couldn't take out yesterday's highs. Real narrow range inside day for Microsoft. Same with Amazon. Google found new lows today. And here's just another look at Carvana, currently up 1.6% after hours to $24.60 a share. Now normally in these meme stocks, the good trade has been over the last year or so to fade the rips. Every time we rip up, they usually just fall over, and so I'd expect the same thing to happen with Carvana. However, they did just announce that they're going positive EBITDA, and with its high short float percentage and relatively small float at 84 million shares, even though I think this is probably going to fall over, I wouldn't short it here. Because as we know with meme stocks, how crazy can it get? I mean, this could easily run up to $50 a share in the next couple of days or week or higher, or we could be back down at $15 a share next week. So stocks like this are about as close to gambling as you can get. Got a similar move out and beyond meat. I couldn't see any big news coming out in the stock. Other than that, it's highly shorted as well. So a big volume day coming off a really depressed low here. And once again, this stock could short squeeze a lot higher. Then will probably fall over again like it always does. Got a pretty good move up this week. And Warner Brothers, after news came out that CNN CEO resigned. And there's a look at the price action today in Royal Caribbean Cruises. If you're watching the video yesterday, I told you I got short yesterday. Just came off a little bit here today. Too early to say if we're putting in a top here. It is a little bit of a topping formation, but we do have a lot of strong momentum in the stock. We can see that in the wave flow. So I wouldn't be surprised if we go up into this big resistance zone in the high 90s, and I'll still continue to hold the stock short. And what I forgot to show you yesterday was another reason that added to my conviction in the short was not only are we technically and fundamentally really stretched and overvalued up here on the stock, and it's a really vulnerable company going into a global recession with a huge debt to equity ratio. What we also saw in the last month was corporate insiders, including the president and CEO, and also the president and CEO of the international unit, offload millions of dollars worth of stock. In fact, collectively, insiders sold over $70 million worth of stock in May. And so just looking at the weekly chart, I'm happy to be on the same side of corporate insiders and taking advantage of these high prices. But like I said, we've got a bit of resistance up around these mid-90s, so we may come out and tag the mid-90s. And I'll reassess then and maybe add to my short position up there as well. And not much else to report in active stocks here today. We've just got the banks hanging in there and Charles Schwab still holding above its 50-day in a short-term uptrend. And a look at our new SP 500 oscillator. Closed the day at 59.46. Still in elevated territory, indicating the market is possibly near a short-term top. Got a little bit of a jump in the global net liquidity model today, but still a huge 500-point gap between the SP 500 and it. And because of that and my S&P 500 oscillator indicator and a lot of other intermarket divergences in the market, including upcoming bearish seasonality, that's all telling me to keep my portfolio tilted net short to the tune of 60%. And so I continue to believe that we are close to making a short-term top in the market here and a bit overdue for a decent 5-10% correction, and possibly more if we get some unexpected bad news. And that's a wrap for today. Thanks for sticking with me this far, and I wish you the best of luck going into the last day of the week. See you again tomorrow.